Dear Thomas, esteemed Professor Brunnermeier, dear guest, I'm delighted to welcome you to ETH Zurich for another highly stimulating evening. This is the 7th annual Karl Brunner Distinguished Lecture of the Swiss National Bank that we have the honor to host here in this auditorium. We, of course, largely benefit from the great economic thinkers that this event brings to our university. So thank you so much. This year's topic is of particular interest and relevance for engineers and natural scientists, as it revolves around the concept of resilience. Resilience is a term that was already in use in the 19th century in the physical sciences. It originally described the elasticity of a material and its power to return to its original shape after deformation. Did you know this? So I remember there was this curve with, going down and how much it recovered and the level it recovered. And so in physics, sometimes it recovers more than the starting states, which might be an interesting point to look at. Since those days, the term has acquired many additional meanings. And today, it is probably one of the most popular concepts in academia and beyond. As parents, we read in media how we can help our children to overcome personal crises and strengthen their psychological resilience. Our own students here at ETH encounter the concept in many of our study programs. And on a broader scale, citizens in Switzerland just voted 3 months ago in favor of a law intended to strengthen the resilience of the country's sustainable energy supply. As a university of science and technology, much of our research is directly or indirectly connected with the question of how to increase the resilience of complex social, technical systems. For instance, ETH Zurich operates a lab on future resilient systems in Singapore, where our researchers address the increasing challenges of interconnected world and the complexity of its infrastructure systems. It is part of our DNA at ETH to collaborate with partners in academia, industry, and society at large. So we work closely with the Swiss National Bank and have already experienced some successes in past projects that contribute to a more secure and more resilient financial system. I guess you know what I will say next. I would like to mention here that the secure Swiss financial network that has been in operation since 2021 is based on the science technology developed here at ETH by 3 professors from ETH, from computer science. And SNB was a pioneer in introducing this technology that makes the internet more resilient. And by the way, yesterday the Swiss Parliament took the first step to introduce this technology as the new standard for the federal administration. So if they manage, everyone will manage. The accumulation and overlapping of various crises in recent years have brought the concept of resilience to the forefront of academia and politics. It is hard to believe that in just the past 3 years, we have seen a pandemic and the associated disruption to our health system and global supply chains. Then following the worst of that crisis, we were confronted with a war in Europe, with all consequences on the energy supply and immigration, for instance. And more recently, Switzerland faced the abrupt end of an era for one of the major Swiss banks, Credit Suisse, that was founded by Alfred Escher. I have to mention that Escher was also one of the leading forces to create ETH Zurich 160 years ago. And now a personal note, Thomas, I want to congratulate you for what you did in such a short time and turbulent time. I mean, this is amazing. And I want you to know, to thank you for what you have been doing, and your team, of course. In all corners of the world, we are confronted with a manifold of crises, Sometimes we call it a polycrisis. I don't like this name, of course. In addition, the world has never been as interdependent and interconnected as it is today. And we know from experience that disruptions and failures at one end of the world can quickly escalate into a global crisis. That is why the stability and robustness of the world's financial system is of central importance. It is therefore a perfect time to hear from a world expert on how the concept of resilience applies to the central banking system. I'm very much looking forward to Professor Brunnermeier's lecture, and now I hand over to Thomas Jordan for the introduction of our guest speaker. Thomas, you have the floor.
Ladies and gentlemen, I'm very pleased to welcome you all to the 7th Karl Brunner Distinguished Lecture. We are delighted and honored that Professor Markus Brunnermeier has accepted our invitation to give this year's lecture. I also want to thank the ETH Zurich, and especially its president, Joël Mesot, for their hospitality and the very nice word that we heard before in his introduction. Well, the Swiss National Bank established this annual lecture series in honor of the Swiss economist Karl Brunner, one of the leading monetary economists of the last century. Our aim with these lectures is to reach a broad audience and to contribute to the public debate on issues related to our mandate. Markus Brunnermeier is an ideal person to hold the Karl Brunner lecture. Markus is the Edwards S. Sanford Professor of Economics at Princeton University and the director of the Bentheim Center for Finance. His research is of great relevance for central banks. This includes his work on systemic risk in the financial system, price bubbles in stock markets, liquidity crises, and digital currencies. In addition to being an outstanding scholar, Markus is a role model when it comes to cultivating the dialogue between academia and the general public. The voices of academic economists are vital for sustaining a productive public debate on major economic issues of our time. Markus takes this responsibility very seriously. He has the rare gift of being able to reduce complex issues down to the essentials without compromising on academic standards. This is one reason why Markus was awarded the Deutsche Wirtschaftsbuchpreis for his book, The Resilient Society, as well as the Ludwig-Erhard-Preis für Wirtschaftspublizistik for his contributions to inform the public debate. Now, it was not always obvious, however, that Markus would become a world-renowned economist. Growing up in Landshut, Bavaria, his career seemed mapped out for him. He was to take over his father's carpentry business. As we know, Markus ended up taking a very different path in life. Nonetheless, his observation that he has probably hammered in more nails than any other economist might well be true. Be that as it may, rather than taking over the family business, Markus completed his Abitur via the so-called Zweiter Bildungsweg and began studying economics at the University of Regensburg. After only 2 years there, Markus moved to the US, where he earned a master's degree in economics from Vanderbilt University. A few years later, he completed his PhD at the London School of Economics. Markus was then appointed assistant professor at Princeton University, and in 2006 he was promoted to full professor. Much like a carpenter spotting a leak in the roof, Markus has a keen sense of where additional research is most needed. Whenever economists lack good models for analyzing current developments, Markus tries to close these gaps. A defining event early in his career was the dot-com bubble. In the years before the bubble burst in 2001, the stock prices of many technology companies reached levels that were no longer connected to fundamentals. Even more puzzling was the fact that many investors who bought these stocks probably knew they were overpriced. Markus showed in a paper co-authored with Stefan Nagel that US hedge funds, which are generally considered to be well-informed, invested heavily in technology stocks. At the time, economists struggled to explain how such price bubbles could form and why even sophisticated investors participate. Together with Philippe Abreu, Markus developed a model to explain this phenomenon. The key insight is that even if many investors individually know there is a bubble, no one knows for sure how many others know about this bubble and when they will sell the stock. It can therefore be perfectly rational for informed investors to ride the bubble while it lasts and then try to sell their stock before others do. The macroeconomic effects of the dot-com bubble were limited compared with those of the global financial crisis in 2008 and 2009. Economists were faced with a difficult question. How could losses in a particular segment of the US mortgage market trigger the largest global economic crisis since the Great Depression? The standard macroeconomic models of the time were not suitable for answering these questions since they largely abstracted from the role of the financial sector. Here too, Markus took on the challenge of bridging the gap between theory and reality. Together with Joël Sannikov, he developed a macroeconomic model with a financial sector that has since become standard in the literature. In their model, the resilience of the financial system is severely impaired when it operates with little equity. In such cases, even modest losses force financial intermediaries to cut back on their lending. The reduction in lending amplifies the negative effect on asset prices, causing intermediaries to reduce lending still further, and so on. Because of such negative feedback loops, relatively small shocks can have large effects on the financial sector and the real economy. In recent years, Markus has increasingly devoted his attention to new forms of digital currency. This is another area where economic theory lags behind real-world developments. In his work with Joseph Abadi and Jonathan Payne, Markus studies the competition between different cryptocurrencies and analyzes how regulators should react when technology companies issue their own digital currencies. In an article jointly written with Harold James and Jean-Pierre Landau, Markus describes a future in which privately issued digital currencies are used to settle transactions worldwide. Against this backdrop, the three authors emphasize the importance of maintaining the official currency as the dominant unit of account. They posit that in order to achieve this, central banks may have to issue their own digital currency. Another paper, which Markus co-authored with Dirk Kniepelt, examines precisely how the introduction of central bank digital currencies, or CBDCs, might impact the real economy. They conclude that negative effects could be averted as long as banks can replace lost deposits with funding from the central bank. The pros and cons of CBDCs need to be considered carefully, and so far no consensus has formed among central banks. Markus' contributions to this important debate is most welcome. While much of his research revolves around financial markets, Markus is an economist with a broad intellectual horizon. His book, There is Resilient Society, which was published in 2021, exemplifies this. Inspired by the coronavirus pandemic, the book analyzes how societies can cope with crises. Markus highlights that a society's ability to bounce back after shocks depends on many factors. Social norms play a key role in driving people to cooperate in an emergency. From markets, free markets ensure fast and innovative solutions to new problems. Economic policy also has an important role to play, for example, by supporting otherwise healthy businesses in a crisis. In today's lecture, Markus will focus on what central banks can contribute to societal resilience. I look forward to hearing more about this important and timely subject. Ladies and gentlemen, please join me in welcoming Markus Brunnermeier with a big round of applause.
Thanks a lot for inviting me. It's a big honor to give this lecture. And also thanks a lot for the president of the ETH and also from Thomas Jordan, president of the Swiss National Bank. It's a big honor to be here and talk to you in this way. It's also a big honor to talk of Karl Brunner in the sense that he touched my life in several points. I was, of course, to his constant seminar series, which he established. I published with Dirk Nippelt in the journal. He established the Journal of Monetary Economics. And I share part of my name with him. That's why I changed my spelling this way. As Thomas pointed out, I worked recently, I thought a lot about resilience. And today I would like to say how does resilience touch monetary policy and how we can think about resilience in the monetary policy context. So let me just start with things. So we have, of course, a risk management approach to monetary policy, where we say we don't just look at the mean forecast, but we also say how bad is the outcome. So if you, for example, change the interest rate policy, it could be that it might go very bad in one direction, but only partially bad in the other direction, and you take this into account. So you take the payoff into account that the risk is actually asymmetric. It could be that distribution is skewed, but it could also be that the payoff is very skewed. And that's essentially what we mean by a risk management approach or a risk approach, where we go beyond the probabilities, but also the payoff weighting of it takes into account. What I want to do today in contrast with is what happens if you focus more on the resilience approach. And what is special about resilience? Resilience means that you bounce back. You might be hit by a shock, you take the hit, but you have an ability to bounce back after the shock. And as President Joël Mesot pointed out, of course, the term resilience comes originally from physics and material science, how quickly a certain material, if you stress it, comes back. And of course, I will put it in a particular context here. I won't go too far. But the question is, you have a shock, and now you're able to bounce back or not in either direction, or is actually the danger that actually this whole thing will spiral out of control. And you can see already the inflation anchor perspective plays a hugely important role, and I will come back to that. But there's a third approach. So besides the risk approach, this resilience approach, there's also a robustness approach. So you can think of, how is something robust? And one way to contrast that is the robustness approach means it should work most of the time especially in the worst cases, it works really well. You have a very simple way to approach this, and you don't fine-tune it, you don't react, you just let it run, and it's very robust. That's the robustness approach. While the resilience approach is more responsive, so you react to changes in the environment in a more responsive way. You test the waters, you might take the risks, and this way you can actually achieve, on average, a higher payoff. So the way to contrast that is, so in a figurative sense, that's what I do in my book, is that there's the oak and there's the reed. So the oak is something very forceful and it's very rigid. It does not adjust much. But one should not compare rigidity with stability. So rigidity does typically not foster stability. And if there's a wind, the oak is actually standing very strong. But if there's a hurricane, then the oak falls over and cannot come back up. While the reed is constantly bouncing back and forth, and it seems weak, but it actually can always bounce back and seem stronger. And if we look at the volatility of the oak versus the reed looks very volatile and weak, but at the end of the day, it's actually the stronger entity because it can bounce back. So it's the mean reversion which matters. So rather than focusing primarily on what we did in the risk approach is on the variance and dispersion of the risk, let's focus more on the mean reversion component, which is a different emphasis to focus on the mean reversion. And the response is, you bounce back, and you bounce back because you're agile, you react. So it's a reaction which is very critical. So you have to react quickly enough such that you can still bounce back, but you can also, try out certain things if you have to try certain things. So let me go to this resilience management a little bit in more detail. So I talked about risk, robustness, and resilience, different approaches, but I would like to say a few words about the resilience management, how one can view it in a very informal way. Okay, but that's what the idea is. So in general, what you have in the resilience, you have a path, if I can point to, there's this path, you can have a riskless path, which has essentially a lower growth rate, but you have a resilience path, which has a higher growth rate if you can bounce back, so the average growth rate is higher, so you can achieve a higher growth rate, whatever it is. It could be GDP, it could be many other things. But there are certain things you have to watch out for, and one thing you have to watch out for is traps. So if you have hit by a trap, then you're stuck at these traps, and this you can also refer to as resilience barrier. So once you hit this trap, you're stuck. And so there are certain resilience enhancers and there are certain resilience destroyers, and traps are big resilience destroyers. Now, there's even a more pronounced way to have resilience destroyers if you have tipping points. So tipping points, then when you hit a tipping point, you get in some adverse feedback loop, and then the whole situation spirals out of control. So rather than being trapped, you actually the situation gets worse and worse. So you have this adverse feedback loop with spirals, and then there's a danger that things get out of control. One example is, for example, if the inflation anchor breaks and then inflation is spiraling out of control. You think of second round effects, third round effects, and so forth in this context. So you have feedback loops, you have a shock from one to the next, and then it feeds back, and then you have actually a big feedback loop going on. Now, how do you control this, and what are the measurements you can take to control it? There's essentially two ways to control it. So one is an ex-ante perspective, where I push this barrier further away. So my barrier, oops, sorry, this was a mistake. I push the barrier, which is here, the dashed line, I push it further down. So in the dashed line, it was the case I was hit this tipping point, and this whole thing would spiral out of control. But now I do some ex-ante investment, and I push this barrier further down. So the tipping point is further away, so I'm not hitting this tipping point anymore. And that's, by building up extra buffers, war chest, foreign reserve buffers, and so forth, you can actually avoid that. You can also make sure that you avoid the overheating of an economy. So you move essentially things away and keep a bigger distance from the tipping points. And this requires ex-ante investments, and this enhances the resilience of the whole system. It also enhances robustness if you go for a robustness approach. So that's one way to go. And that's the alternative way. The second way is to increase the agility of the policy making to react earlier and to turn things around. So the second way is essentially, rather than moving this tipping point down, you can actually say, okay, I will react earlier, and this way, instead of having this dashed blue line, I have one which doesn't go so far, and this way I can also avoid hitting this tipping point. And that means I have to react as a central bank in a more timely fashion. And it also, there's a question then, should I react? Should this be part of a rule, or should this be part of discretion? Okay, that's a secondary question I will address in a minute. And the other question which often you have to answer yourself, is this one large shock, or is it a sequence of smaller shocks? If it's a sequence of smaller shocks, you can react to that. If it's one large shock, it's very hard to react to it. So for large shocks, you have to go for this moving the tipping point away. But if it's a sequence of smaller shocks, and after each small shock, it can be very rapid. But if you can react to that, then the second approach is a more exposed approach and is more cost-effective to do. The second aspect I would like to emphasize is that the reaction and the impact of your reaction depends, of course, on the expectations of the others as well, what the others expect your reaction will be. So I call this the re-reaction. So you have some certain reaction to something, and how the all others react matters a lot. So that's very much when the central bank reacts to a particular shock, how does the rest of the economy react to the central bank's reaction? And this plays an important role. And for these expectations and also higher order expectations matter a lot. It's not only what I expect about the others, but what the others expect about me, and what I expect about the others, what they expect about me. And that's also coming back to this bubbles component, which was mentioned by Thomas before. Now, so when there's a reaction going on, so you have the challenges of a central bank is right now, and I will talk about several big challenges central banks face in particular now. One is that everything is moving much more fast, and so we have less time to react. So the predictability of future outcomes is also more difficult to predict. So you have less predictability, and that makes actually this reaction more difficult, and the reaction time has to be adjusted for that, and there's always a danger to be behind the curve. So what you need from this is actually to have more responsiveness to the data, in the monetary policy world, a higher Taylor coefficient, and also more buffers. So these are the two ways you can react to that, referring to the previous slide. So that's essentially one of the big challenges, and I will highlight the other big challenges for central banking these days, is that things move much faster. We have this polycrisis, using this unpopular term. Then it actually makes it much harder to react, and we have to take this into account when conducting central bank policy. Coming to the point I mentioned before, should you use much more discretion or much more ex-ante rules? And in both is actually, that's an orthogonal question, whether you should react or not. So because you can also have the reaction built in some ex-ante rule, or you have some discretion where you decide ex-post. So if you have ex-post discretion, it's easy to adjust to new circumstances because you have discretion. But then monetary policy has less power because the other players don't know how they should react to you and how you will react in the future. So having a rule gives actually makes it harder for you to adjust ex-post, but if it's baked in the rule, other players in the economy, other entities in the economy, they know how you will react more generally in these circumstances. But it also leads to, if you have a very complicated rule, it makes it much more difficult to communicate to the public. So that's a trade-off in this regard as well. But the standard trade-off is that if you have discretion, you get to the standard timing consistency problem that you would like to promise something and indicate you will react in a particular way, but then when the occasion occurs, you might have exposed different incentives and do something different, and you'll undermine your credibility. And then this would speak, that's the problem for discretion. On the other hand, if you have a lot of unforeseen contingencies, things you didn't anticipate at all, then the rules will not capture that. So that's essentially the standard trade-offs we face in this context. What's also important is as I mentioned before, this was this 2B point where it's the inflation anchor matters a lot. So one thing when things spiral out of control, if you lose the inflation anchor, I know it's probably not the first order importance for Switzerland, but for many other countries, one has to think about that. And then you have to see what is such an inflation anchor. And I think what's very important is that an inflation target or inflation anchor is some convention, and it's common knowledge. So it's not only that I know that it's 2%, I also know that others know it's 2%, and I know that others know that I know that it's 2%. So you have this knowledge in the society that everybody agrees on this, and moving this anchor, I think, is very, very difficult. And losing this anchor would be a big loss in a sense. So what strengthens such an anchor, how can such an anchor be broken? If you offer an alternative anchor and confuse a society, then actually that makes it much more difficult. So if you don't have another focal point, then it actually strengthens the 2%. If you don't play around, or there will be another focal point of 3 or 4%, then actually that makes it easier to shift to another one. And of course, the narrative is also key. The communication of the central banks is also key to doing this. But in general, it's not easy to re-anchor expectations because it involves all these higher order beliefs in order to re-anchor the inflation expectations. Now, I mentioned already that one thing, and we often were challenged the central banks in community in general, is that there was the forecast, the predictability became much more challenging in our models, and that's because in many of these models, it's essentially assumed you go back to the initial anchor, and it's not possible actually that the anchor can break, and that's essentially some bias which is built in these models, and I think we have to be much more careful in analyzing this. This is just the forecast by the Fed, what the inflation will be, and you can see that the so-called hair diagrams are showing always how transitive people thought the inflation would be. But the same is true also before we went to the high inflation environment. When inflation was depressed, it was also always anticipated it will go back to 2%, and it didn't go back so quickly, so it goes in both directions. Let me say a few things, more abstract things about what's the difference between risk and resilience in 2 dimensions. So one is diversification. Because if you think about diversification, that holds for monetary policy, but it holds more generally. It's different whether you have a risk diversification or resilience diversification. So risk diversification means you want to spread across many, many different instruments or assets, and also you want to have a little bit of exposure of all of them, and in each a little bit, so you don't put all the eggs in one basket. And like in monetary policy, it would mean you have a lot of monetary instruments and you try out all of a little bit, and in order you make sure that at least one will work a little bit, so you minimize the risk exposure. The resilience diversification is different. You might also do many little things, but the motivation is very different. You want to open up many doors. And then if you figure out one is working better than the other one, you're able to scale up very quickly this particular instrument. So it's not about spreading the risk and being exposed to all the risk only a little bit. It's about opening the possibility to react in a more efficient way. So it's a different form of diversification. So it's very much, you experiment and try something out, and then you have essentially the ability to scale up whatever works and scale down what doesn't work. And that increases the agility and the reaction speed you have. But in both settings, you have this diversification aspect. So, or if you go to global value chains, so that's another example, you could say, okay, I would like to have suppliers from 3 different continents, and hence I will, expose myself to risk from 3 different continents, so I've diversified my risk. That's a risk diversification. But if your thinking is, I would like to have suppliers from 3 different continents, and if something happens in one part of the world, I can just shift and scale the other thing up. I can react to that because I've already set up the groundwork beforehand. That's resilience diversification. So it's a different concept. Now, the other concept I would like to introduce is of course, we have covariance, we have the covar, and other things in terms of measuring the co-movement of different random variables. But you can also think of the co-resilience, which is more like a process of a particular variable or x. The realization of it affects the mean reversion of another variable. Okay, so it's not about how they co-move right now, but it could be that one variable is moving down, and that destroys essentially the mean reversion, the resilience of the other variable. And so example, there's a negative shock on financial stability, and because of this negative shock of financial stability, you use up some resources which generally allow you to stabilize the economy, and it moves you closer to the tipping point from a monetary policy perspective, and it makes the monetary policy and the price stability less resilient. So there is some spillover going on from one stability concept to another stability concept, and in terms of resilience, it just makes it harder for you, if there's another shock, to bounce back because your mean reversion is negatively impacted. So it's not about the covariance in a sense, it's just the connection of one variable with the mean reversion of the other variable. So these things one has to keep in mind, and they help us to think more how to think about resilience in a dynamic setting. So I mentioned already, I wanted to highlight a little bit what are the big challenges central banks face going forward, and that's more from a global perspective. And one I mentioned already, it was the first one, it's because we have these more numerous crises, and every crisis comes with a different shading, so it's very hard to predict the inflation. It's much harder than before. And we talked about this. This requires a more agile, more open-minded, you have to make sure that you don't fall behind the curve. But let me highlight 3 more other aspects which are drastically different from earlier periods in time. So one is essentially we have huge government debt levels, perhaps not Switzerland, but in many countries. And this has huge implication on the monetary fiscal interaction. Now, if you increase the interest rate as the central bank, this has huge implications for the fiscal budget. And of course, there will be political pressure pushing this back. So the political pressure coming from the fiscal side or from the government side, it will be way more pronounced because the government debt level is so high than it was in previous cycles. So we never had such high debt levels in peacetime than what we have now. So this will be the fight for central bank independence will be much more under threat, and we have to be preparing for that. The other thing is that we have high private debt level as well, and we have inflation, and I will allude to that. Before the inflation was high, doing something for financial stability reasons was also doing something to get inflation closer to the inflation target of 2%. Now things move in the opposite direction. So before they were in congruence, now there's a trade-off between financial and price stability. Of course, in the time dimension, there was always some trade-off, but here it's now much more stark. You might want to do something for financial stability reasons, but you feel like you cannot do it because it will actually hinder the price stability, inflation will go up, or the other way around. And then we have various transition phases. We're in big transition phases, and this might impact not only R star, but the risk premium as well. Of course, monetary policy is not there to do structural reforms, but the transition phase itself will change the underlying nature of the economy, and then the question is how should monetary policy react to that, taking this into account. Of course, it's not the main instrument to conduct any of these. So let me go through these things and also highlight a little bit in the context of resilience, where I said, okay, one big thing is traps, you're trapped, and also have this tipping points in this context. And the first thing I would like to say is that you have to have, as a central bank, you have to have a trap thinking in mind. So you have to think, okay, if I do something, what will result out of that, and I might be trapped down the road. I think think everything in terms of traps, and the trap might come from the fiscal side, might come from the financial instability side, it comes from various different corners. And I want to talk about how to avoid these traps and how it helps to have this ex-ante way of thinking, and and how it connects with forward guidance, the fiscal dominance trap and the financial dominance trap in this context. So the first thing is, the first trap in a sense is that, if you do forward guidance, explicit forward guidance, you immediately have a trap because you have this, you force yourself, you tie your hands down the road, you can't react anymore subsequently. And there were many hidden forward guidance traps which were not explicit forward guidance. So we, of course, could say, okay, we will not raise interest rates until a particular point in time or until particular circumstances occur, but there were hidden forward guidance in form of a so-called data-driven approach, which means we will not increase the interest rates until certain data show up in a particular way. And that was essentially a hidden form of forward guidance. There was another hidden form of guidance that the way we will stop all the stimulation is in a particular sequence. That was another forward guidance. You only raise interest rates after QE measures are completed. And that in the US in particular, it lasted till February 22 to get all this QE measure completed. And then only then afterwards you can do some interest rate increase. Now, so this forward guidance, whether it's explicit or hidden, is immediately a trap in a sense, or is binding your hands. You can't react to that. And anything which doesn't allow you to react is essentially reducing your resilience. But the second thing is, one you really have to keep in mind is that fiscal and monetary policy are intertwined and will be very hard to disentangle for several reasons. Of course, there are different thoughts about it. So there are two traditional views where saying, okay, if you do some fiscal stimulus, this creates some aggregate demand effects, and because of the aggregate demand, there will be inflationary pressures. Or you can also, that's purely a contemporaneous phenomenon, or you can have a fiscal theory of the price level perspective, or also Sergeant Wallen's perspective. I mixed them up even though they're different, in a sense that you might do a fiscal stimulus, you have essentially down the road, you have a higher debt level, and the higher debt level will essentially lead to higher inflation, because it's the only way to get out of this higher debt level. And if you look at this from the CBO, Congressional Budget Office, if you look at the projection, this is actually done earlier, the situation looks worse now. That's how the projections for the debt level for the US looks like. And that's, I think, the challenge we will face. And as I said, this will lead to huge implications for the battle between the central bank and the fiscal authorities. Because when the central bank is raising the interest rate, and by the Taylor principle, not only the nominal but also the real interest rate, that actually will lead immediately to extra costs for the budget, and the budget has to squeeze or not, and the question is who will win this aspect. No, that has also implications, so any central bank movement also has implications for the central bank's balance sheet. And I would like to emphasize one new tool, which probably will be hotly debated in a few months' time, is, should there be interest rate paid on required reserves or only on excess reserves? And how big should be the required reserves and how big the excess reserves? With QE, of course, we uploaded the system with a lot of central bank reserves. And if the central banks pay huge amounts of interest rate on the reserves, on the excess reserves, but not on the required reserves, there will be at some point Congress or some fiscal authorities saying, why do we pay all these billions of euros or dollars or to the private banks? And there will be pressure to increase essentially the required reserves on which you don't pay interest. Then the ECB has just changed the rulings that they don't pay interest on required reserves. So this is a big topic, and it has huge implications. Of course, you could argue that the banks get for their depositing some resources with the central bank, they get a huge amount of money for that, while an individual citizen, even if you hold CBDC, which is not remunerated, will not get this. And so that's one thing. Of course, when the central bank raises interest rates, it will also, because of buying all these long-term government bonds through the QE measures, will have some capital losses from that, and there will be some headline risk as well, and that also might limit down the road how much you can increase the interest rate because you increase the capital losses on the long-term government bond positions you have. So for this, I think one has to take this into account. And what's really important is that you can actually, central banks, as everybody knows, can of course have negative balance sheets. They can be negatively capitalized, so the equity can be negative, but only to a certain degree, only to the degree that it is covered by future expected seigniorage from the central bank. And this requires a huge, very delicate communication by the central bank to handle this, because otherwise you lose your monetary dominance. We will move to a fiscal dominance regime going on. So the narrative is it's not unlikely that we have a huge blame game that, going on. Why are these big losses? What have been done beforehand? And this will be a big challenge going forward. Now, the next one is, of course, financial dominance. And as I mentioned before, when the inflation was low, it was actually fine because you could do many things which stabilizes the financial system, and you can at the same time also bring inflation closer to the target from below. Now it's a different system. Now we have a high inflation environment. Now you might want to do something which brings inflation down, but at the same time, if you do this, this will actually also hurt the financial stability. So there's a trade-off. You move from a congruence to a trade-off. That changes the whole dynamics where this is going. Of course, when the central banks were very active for very long, and there's, of course, one has to take into account that if you do something for very long, the side effects at some point dominate the actually immediate positive effects of any measure. So very prolonged interventions, at some point the side effects dominate the initial intention measure. So that's a second component. And of course, we have this doom loop or diabolic loop between the financial risk and banking and the government risk. Now, let me just say a few words about the resilience after structural changes and transition phases. So that's essentially, we have 4 structural changes. So one is the green transition. And the question is, how will the green transition, which requires huge investment needs up front, how will this impact our star? So the neutral interest rate. And of course, as neutral interest rate is impacted, it will also impact then monetary policy. So there's reduced investment needs in dirty technology, but there's this huge investment needs in green technology. And green technology typically is much more upfront investment than having some extra cost exposed. So if you just think of solar energy, essentially the initial investment is the biggest investment, and then producing electricity subsequently is fairly cheap, so compared to other forms of producing electricity. So that's essentially, you have a huge amount of initial investment, and of course there will be more investment. We had this trend that the risk-free rate was trending downwards, at least since the 1980s, but this might actually turn around the other way. Now we will experience a much higher R-star, and this has implications for central banks as well. There's a change in preferences, I would argue, from working from home. So many workers, they prefer to work from home. There's more leisure. There might be lower labor income. That makes it even more difficult to serve essentially the fiscal situation governments face, and that actually then tightens the monetary versus fiscal battle as well. Similarly, we have this demographic change. There will be a difference, more people retiring. There will be this saving. We have experienced this in Japan. There will be more saving is followed then by more this saving. So there's a shift, and this might also affect the R-star and the setting. And then you have deglobalization as one of the big drivers, and there's some efficiency losses from there. And finally, there's digital money, which I might talk tonight for a few minutes. Before I do this, let me go to international resilience. So how about just thinking about the international interaction, also a little bit about exchange rates, because one can think of a flexible exchange rate mechanism as a big resilience enhancer. Okay, so think of the resilience will be enhanced by having exchange rate devaluation. So one way, how can you have a resilience? Can you better resilience with a flexible exchange rates or with a fixed exchange rate and buffers and reserve foreign exchange holdings? And one way to think about it is, if there's exchange rate devaluation, it's an implicit transfer at the expense of other countries. So essentially, you devalue, you can actually export better. So there's essentially a global risk-sharing agreement. If everybody agrees, let's suppose there is the world and some countries face some shock, and these countries are allowed to devalue, boost the export, and can grow out of it again. So this enhances resilience in this sense. So if this is understood to be temporarily, some temporal devaluation, and it can help out after some idiosyncratic shock to grow out of it, it is actually a resilience enhancer. So you can bounce back, and there's this whole literature by Karl von Phoenix Miracles that many of these economies, through the devaluation, they were actually growing out of these shocks again. Of course, there's a problem if a lot of this debt is denominated in foreign currency and original sin aspects, but in general, having this flexible exchange rate is a way to enhance resilience if it's used appropriately. But of course, if it's not temporarily and if it's not mutual, if it's continuously done and excessively done, then we end up in the beggar the neighbor sense. So it's not a risk-sharing agreement, a gentleman's agreement where we're saying, okay, we understand this as a temporary mutual arrangement, and this way we can help each other and insure each other and create more resilience in the system. If it's excessively done and continuously, then you end up in a beggar the neighbor system, and then it makes the whole system much less stable. So that's I would argue that the exchange rate, the flexible exchange rates used the right way is a huge resilience enhancer in the global international context. In contrast, if you have fixed exchange rate, you have to work with buffers and reserves, so you need much more reserves, and to push essentially this resilience barrier I mentioned earlier, you have to push it further down, further away. And that's, of course, if you have a lot of reserves in the central bank, it will encourage the domestic firms and others to issue more debt in foreign denominated currency as well, which is, undermines essentially the central bank's reserve holdings. But overall, what you want to do then in this world is to go more for the reserves, build up reserves, which pushes then, is like pushing the resilience barrier further away from, the tipping points further away. Now, one big thing what destabilizes the international financial system is international capital flows, in particular flight to safety. In my view, the flight to safety is the biggest issue, and it's also, for Switzerland, there's a huge flight to safety coming in. And it destabilizes the global financial system in a sense that when we're in a risk-off world, everybody goes into safe havens, everybody goes to flight to safety, and it flies out of the emerging economies into few advanced economies. If you go on the other way, it goes the other way around. So in order to understand this, we have to understand what are safe assets and what is this flight to safety. And is the international monetary system set up the right way to handle this? And why do we have this flight to safety in the first place? So for me, a safe asset is like a good friend. A good friend means a good friend is a friend indeed, a friend which is around when you need it. So a friend in need is a friend indeed. And what does it mean? If you have a negative idiosyncratic shock, which is very particular to you, you can actually sell this asset at a high price when you can overcome your financial hardship. So it has to be tradable and it has to have a high price when you have a financial hardship. But it also means it's also a good friend when there's an overall crisis. So it also appreciates in bad times more generally. Okay, so that's for systematic and to hedge a systematic risk. So in CAPM world, it has a negative beta. Okay, so if you have an asset which individuals use for the individual idiosyncratic shocks, and if you assume that if you're in a general crisis, these individual shocks will be much bigger, the value of this asset is actually going up in times of crisis. So more generally, what you should think of is that an asset price is not only the expected present value of future cash flows, but also the expected present value of future service flows. And the service flows comes from the fact that we can implicitly insure each other. So let's suppose markets don't work well, so in a sense that we cannot insure each other. Insurance markets don't work well, but we can all save in the safe asset, and some of us are hit by a shock and others are not hit by a shock. And the guys who are hit by the shock, they can sell the safe asset to the guys who have a positive shock, and this way we can insure each other through retrading. Okay? So even though we cannot write insurance contracts, through retraining of a safe asset, we can insure each other. Okay, and that this safe asset, in a sense, provides this additional service flow from the retraining. And this essentially allows to overcome the financial frictions which are in the market more generally. So now, even if the asset here has zero cash flows, it doesn't give you anything, but it allows us to retrade and insure each other depending where idiosyncratic shocks are happening. It actually has some value and has a positive price. Now, assume further the idiosyncratic shocks we are facing is more dramatic when we're in a crisis period. So the value you get from this retrading will be more dramatic in times of crisis. So this thing is actually going up in times of crisis or in a recession. Okay. And that means the asset is actually gaining value exactly when there's a crisis. Think about the Swiss franc. And that means essentially you have a negative cap M beta. Okay, so because of this, it comes endogenously from the system. First, you coordinate on some asset, and this asset will actually lead to say, okay, whenever we have some shock, we can actually sell it and we can insure each other. And this need for this reinsurance and this retrading is way more pronounced in bad times because we have more idiosyncratic shocks. But then it also means it will gain in value in bad times. So overall, even if there's an aggregate shock, a systematic shock, then it has a higher value, and that actually makes ex-ante even more attractable because it has a negative kappa M beta. So it's very valuable in bad times when you really need it, not only for you individually, but also for the aggregate economy. So that's essentially, and of course, there's the safe asset tautology, which is essentially a safe asset is safe because it's perceived to be safe. It also means you can lose your safety status very easily. If you're not careful about it. So what we have at the moment is we have this risk on, risk off phenomenon. We have this flight to safety, and the problem is not a shortage. There's a huge literature out there. There's a shortage on safe assets. And if you think about it, the amount of US treasuries which were issued in the last 5 years are enormous. So the shortage should be going away. I think the problem is much more that the safe asset is not symmetrically issued across the globe. And that's why when there's flight to safety, it means it leads to huge flight to safety across different parts of the world, and this destabilizes the economy. So it would be more natural to have safe asset more provided more symmetrically around the globe. So in this sense, it's not good for either side. It's not good for the advanced economies, and it's also not good for the emerging economies. The advanced economies suddenly get all these inflows, the currency appreciates, the export sector is suffering from that, but the poor essentially suffer even more because they cannot do some counter-cyclical fiscal policy. So because the finance minister of a poor country suddenly has this huge financial crisis at hand because of capital outflows, he could not run a stimulus program when it's needed. He has to go for austerity exactly when the crisis hits. Now, what I've proposed, and I just would like to point it out here, is a more global safe asset on top of the existing safe assets we have here would be that you pool some sovereign bonds from the emerging economies together, and then you issue a senior bond and a junior bond. And the senior bond is protected by the junior bond. So if there were a default on the senior on the sovereign bonds from the emerging economies, it would hit first the junior bonds, and only if after the junior bond is wiped out, the senior bond is touched upon. So the idea would be that whenever there is a shock, now there's a flight to safety event, and when the flight to safety event occurs, there will be flight to safety from the emerging economies to the advanced economies, but there would also now be a flight to safety from the junior bond to the senior bond. So you rechannel some of this flight to safety capital flows away from being cross-border capital flows to be cross-asset capital flows from a junior bond to a senior bond. And both of this junior bond and the senior bond are both emerging market bonds. So I've proposed this early on for Europe and so-called SPs, but this whole concept also works at a global scale, and it would stabilize the whole, it's self-stabilizing. So you don't need to, a system we have right now, it's destabilizing, it has no resilience, and then the IMF and other institutions have to intervene to help out. Such a system would be self-stabilizing because the flight to safety is rechanneled from across asset classes rather than across borders. So then this would actually stabilize the whole system. So let me conclude. I wanted to talk about resilience and the connections to monetary policy or central banking more generally. I think we moved on to a risk management approach. We don't look just at a symmetric payoff function, quadratic loss function. We look and value different outcomes differently based on the disutility they cause or welfare loss they cause for society. And so that makes a lot of sense. But its risk management is very much looking at the next period, what the risk realization is for the next period. I think what resilience does, it looks many periods ahead. It's not only about how risky is the next period and what are the payoffs across the different realizations, how easily can you react and bounce back. So the bouncing back is not only one period, but several periods looking ahead. And so one has to think about, how can you lose your resilience? So losing resilience would be the biggest loss. And for this, essentially, one which jumps to your face, essentially, is, maintaining the inflation anchor is key. And inflation anchor means it's commonly understood in the population that the inflation will be under control, and there's a common knowledge around it. So it's not only that everybody knows it, but everybody knows it, everybody knows it, and so forth. And you can also allow for temporary adjustments, but you react to it. So this reaction is important. So there's two ways to push. On the one hand, you want to put the resilience barrier, you want to push it down, so create bigger buffers. That gives you more resilience. But it's also to react in a timely fashion on new information. In particular, react very quickly when you hit potentially a resilience barrier. And you want to avoid these traps. You look out for these traps, like forward guidance limits your ability to react in the future. Financial dominance limits your ability to react, because if you were to raise interest rates or low interest rate, you might hurt the financial sector. You might be reluctant to do so. And as we just think of Silicon Valley Bank as a key example. And you want to avoid fiscal dominance, because you as a central bank might be under fiscal dominance, and it will be very hard for you to control this, having constantly this battle with the fiscal authorities. And then finally, I talked about international resilience and what role flexible exchange rates play, and to what extent we can set up a system with a safe asset system which leads to less flight to safety fluctuations, and this way makes the whole system, the international monetary system, more resilient. Thanks again for